In this session, let's focus on the future markets and contracts, which are more or less similar to that of forward markets to a large extent, but with a couple of minor differences as we have understood earlier itself. One, the future markets or future transactions generally happen on organized exchanges, whereas the forwards are mostly over the counter and more of negotiated, customized kind of transactions. And in the futures market, we talk about scenarios of margins and even the concept of mark to market, where the settlements generally happen on a daily basis, whereas in case of forward market, the settlements generally are at the end of the contract period. Except for these two or three differences, we see that there are not too much of differences existing between the forward and the future markets. So, as far as the calculations are concerned, or as far as the key aspects are concerned, whatever are applicable to the forwards, finding the value or finding the price, whatever are applicable to the forwards, by default they are applicable to the futures also. And wherever there are differences existing between these two markets, we are dealing with those differences specifically in this session. A few things to remember. On the expiration date of the futures contract, whatever is the date, on the maturity date, we observe that the futures price should converge with the spot price. Why? Let's assume that the expiration date of a futures contract is 20th December 13, and today the date is 20th December 13. What is the spot price of any of that asset? Let's say we are talking about the underlying asset as copper, any metal. Now, the spot price of the asset, spot price of copper is the date for the delivery of copper, or the price for delivering copper on 20th December 13. And at the same time, when I am talking about futures price, which is expiring on 20th December 13, this is also the price for delivery of copper on 20th December 13. If the today's date is probably 19th or 18th December, the delivery price for 20th, which is the futures price, may be is different from the delivery price for 18th, which is the spot price. Whereas when it is the same date, the delivery price, whether it is in the spot market or in the futures market, should be the same. So when that is the scenario, the futures price should be same as the spot price on the expiration date. If at all these two markets there is a difference in the price, then arbitrage will be present. So probably if the futures price is greater than the spot market price, there will be heavy buyings that will happen in the spot price on that day, spot market on that day, and heavy sellings happening in the futures market. So because of heavy buyings here, the price will increase here, heavy sellings, the price will decrease, and again they will increase and decrease in such a way that both of them are going equal on that day. So by default, we can very safely assume that on the expiration date, the futures price will be equivalent to the spot price. That is what we mean by the statement, futures price and the spot price converge at the expiration date. Alright, that's one major concept we have to be comfortable with. Then, when we are talking about the value of the futures contract, in the forward contract, if we remember, at any point when we were talking about the value, we were talking about the spot price minus the present value of the forward price. This was what was the typical definition we were giving to the value for the long position. Now, if I have to apply the same concept to the futures, what I would see is this forward price, in this case probably the futures price. This futures price is reset on a daily basis because of mark to market. Right? The futures price is reset on a daily basis because of the mark to market, which means, and this is reset to whatever is the updated settlement price. This is reset to a settlement price and a new contract is opened for the next day. What does that mean? This price keeps changing on a daily basis, and once there is an update, these two values become the same, which means the value will become zero immediately after the day-to-day settlement. So that is what I meant by this statement. The value of the futures contract is zero after the adjustment to the mark-to-market losses and profits. Probably after my margin account is updated with the loss or the profit based on the mark-to-market settlement price. There is no outstanding loss or gain to any party at that point. Between two mark-to-markets, so today's settlement price and tomorrow's settlement, in between there is a difference between this, which is nothing but whatever is the spot price minus the present value of the previous mark-to-market price rather than the futures price, previous mark-to-market price. So whatever may be the loss that can exist in a futures market, the loss or the credit risk is generally limited to a single day's loss, because at the end of the day it is already mark-to-market and the accounts have been updated accordingly, so there is no pending loss or pending gain to a particular party at the end of the settlement period. So which means the possibility of credit risk is much lower compared to that of a forward market. So anytime you are getting into the pricing, we are looking at whatever is the new contract that is getting created after the settlement of the mark-to-market gains or losses, whatever is the new mark-to-market price, based on that particular price we are setting the futures price. So the spot is getting updated as on a daily basis into 1 plus r to the power t. The formula still remains the same, but this number keeps changing on a day-to-day basis, and based on this is what we are arriving at the futures price. And as I have already highlighted, between the two mark-to-market dates are probably times. During the day, intraday, the contract value is just calculated similar to that of a forward contract, which is nothing but the spot price minus the present value of the previous mark-to-market price. So that is one other key difference that we observe between a futures contract as well as versus a forward contract. Then another key thing to remember as a contrast between these two: when will people prefer futures over forwards, or when are futures more attractive than forwards, or when are forwards more attractive than futures? How do I differentiate if both the contracts are available? How do I differentiate which one should I prefer compared to the other? For that, there is a small analysis that has been brought out. Check out for the correlation between the asset value and the interest rate, the underlying asset and the interest rates. Now what are we saying? if these two are positively correlated, means as the asset price is increasing, the interest rates are also increasing. Now what is happening? One, I am assuming that the price of the asset will go up in future, and at the same time the interest rates also will go up in future. Interest rates going up in future is an indication that if I get cash early, my reinvestment rate will be much higher in future. So what could very well happen is, and the borrowing rates right now will be lesser, means at a later point the borrowing rates are also going to go up. Now what I could very well do, I can borrow the money now, because the current borrowing rates are much lesser, because there is a kind of a positive relationship between the asset prices and the interest rates. I can lock up the asset price, and the one thing which I can see is comparison to buying now versus buying at a later date, because these two are more positively correlated. What could I do is probably buy the asset now by borrowing at a much cheaper rate, right? I can borrow it at a much cheaper rate, buy the asset now, sell a futures contract, lock up the price and sell the asset at a much higher price later and lock up the profit. So what could very well happen is, even from a seller's standpoint, yes, if I am able to get the cash today, probably I can reinvest the proceeds, which can give me a very high reinvestment value compared to my cost of borrowing. So in those cases, especially when there is a positive correlation existing between the asset values and the interest rates, we see that the futures market will have more preference compared to the forward market. So the futures price will be greater than the forward price. Futures price will be greater than the forward price, especially when there is a correlation, positive correlation existing between the asset prices and the investment rates, because there is a possibility of getting a higher reinvestment gain even if the cash, even if I get some mark to market cash. You see like this. What is the key difference? The margin account will be updated on a daily basis, right? So if my margin account is updated with a higher value because the asset prices have gone up, look at it like this. Let's say I have gone, I'll take an example. I have gone long on futures market, right? So if I have gone long, my position is a long position. Now what is going to happen tomorrow? If the asset prices are going up, then the futures price will be greater than the yesterday's futures price. Today's futures price will be greater than yesterday's futures price, which means for a long that's a benefit. So my mark to market profits, my mark to market, based on the mark to market settlement, my margin account will actually go up. So if my margin account is going up, I can withdraw from the margin account, and because the interest rates are higher, I can reinvest them separately at a higher rate of interest than my cost of borrowing. So at the end, I am going to get a much higher return compared to a risk-free rate of return, because the interest rates are up, the reinvestment rate is much higher. So if at all I am going to get more mark to market amount in the initial periods, means my margin account is updated during the initial period, I can use those proceeds for reinvestment and get a higher reinvestment return. So if these interest rates and the asset prices are going together, are positively correlated, there will be more demand for futures contract over the forward contract. And if there is a negative relationship or negative correlation between those two, we see the opposite scenario in place. Means the forward contract will be more preferable compared to a futures contract, which means the price in the futures contract will be much lesser than that of the forward contract price. So this is one place where we look at a differentiation existing between the forwards and the futures, and the preference for the futures versus the forwards and vice versa. So now, if the futures price is less than, the no arbitrage price is more similar to that of your forward price itself. So if the futures price is less than your forwards, the simple logic is buy the futures, you short the asset. Buy the futures means go long on futures, means you will buy the asset sometime in future at a fixed price. Right now you short the asset. So you can short it at a higher price, you reinvest it, you invest that proceeds at the risk-free rate until the expiration of the contract. So now that you have locked up your buy-in price for future, you take the delivery at a future date, and because you have shorted and you have invested the proceeds, you get back the money, you pay that, you pay some portion of it to take the delivery of the asset, but you are still better off. See, like let's say, okay, the no arbitrage price, let's say, is 105, whereas the futures price is 103, and the current price, let's say, is 100. Now what are you doing? You are buying the futures. So you are ready to buy the asset at 103 at a future date. You have shorted the asset. So let's assume today you have sold the asset at 100, and you have invested it at a risk-free rate. So you are going to get 105 on the expiration of the contract. Use that 105 to buy the asset at a future date, but the asset at a future date you have agreed to buy it at 103, means you are left with 2. That 2 is your profit, which is a no arbitrage profit in this scenario. So this is how we construct in case the futures price is less than your no arbitrage price, or the futures price is more than the no arbitrage price. You can structure this kind of transactions to lock in your profits. Then when it comes to holding the underlying asset, right, again there is a kind of a discussion between should I sell today versus sell in future. What is the benefit? Right? How should I decide between these two? Sell today versus sell in future. So that is what we mean by holding the underlying asset. Right? When I am selling in future, there are some extra costs that are incurred for me. The most general costs that we are looking at are the storage costs. Probably there may be some perishability depending on whether it's a commodity or a financial security, or what is the underlying asset. And for some of them you may have storage costs. In some cases there may be insurance costs. These are some of the most common costs that are incurred when you are holding on to the asset, which means when you are getting into the futures price for them, it has to account for the entire costs also. Right now if the spot price is S0, it has to account for the present value of all the future costs, at least during the expiry period, during the contract period, whatever are the extra costs, because sell today, those costs are not incurred by you. You don't need any storage costs, you don't need any insurance costs to store that. But if you are selling it, let's say after 6 months, for this 6 months, selling it after 6 months is nothing but you are getting into a futures market. So for this 6 months, you need to actually have a storage cost for your asset. You need to go for insurance costs. So what we are saying is the futures price in that context should be the spot price plus the present value of all the costs involved in it, storage as well as insurance or any other extra costs that are there during this 6 month period or a maturity period. then multiply it by 1 plus r to the power t. This should be your forward price. Same way, we are also talking about a benefit that can come by holding the asset. So any kind of a benefit that I am getting may be monetary, may not be non-monetary. Right? In some cases, there may be a non-monetary benefit also. Right? Probably there is a possibility that the asset is unavailable in future. So better store it right now itself. So there may be sometimes a monetary or a non-monetary benefit. If there is any kind of a non-monetary benefit, we can even call it as a convenience yield. But whatever it is, when I am talking about the futures price, either, see, in all these calculations, either I subtract the present value of the future benefit and then multiply it by 1 plus r to the power t, or the calculation will be, first you multiply this by 1 plus r to the power t and then you subtract the future value of the future benefits. Either of the ways, this calculation holds true for any kind of futures contract or forward contract kind of calculation. So don't get confused between these two. When I am holding the asset, what we are discussing is there are possibilities of some costs, there are possibilities of some benefits that I can get. So the net cost for me is always the storage cost minus the convenience yield, which can work out to be either positive or negative. If I am looking at this to be positive, means my costs are more than the convenience yield. So my futures cost, my futures price should be very much greater. Whereas when we are expecting that the convenience yield is more and the storage costs are lesser, probably we can expect that the futures prices would be much cheaper also. All these kind of things we may have to consider when we are getting into the pricing on the futures contracts. There are both costs as well as benefits involved in that. So we have to take both of them into consideration. Then we are talking about the next set of key points, wherein we use the terms like backwardation and contango. Whenever we see that the futures price is less than the current spot price, so today the spot price of something is 2000, whereas a futures price which is ready for a delivery after 10 days or 1 month, we are seeing that its price is 1980. In that case, we call that particular product is in a backwardation market. Whereas if the futures price is greater than the current spot price, we say that product is in a contango kind of a market. Now in future, if I am expecting, if the futures prices are planned to go down, it means holding the asset will not have much of a benefit, because I am expecting that the price will still go down. So no much benefit to hold the asset. So it's better to dispose of the asset unless I am very much sure there is a significantly strong benefit. Otherwise I will not hold on to the asset unless I know that there is a significantly strong benefit, or unless I am sure that in this particular product the convenience yield is very, very high. Only then there is a possibility of holding on to the asset versus selling it off immediately. Unless there is a significant future benefit exists, there is no point in holding. So higher the convenience yield, when the convenience yield is typically very, very high, we see that product will typically go into a backwardation market. Very rarely observed in financial futures, but you observe this very comfortably in the commodities, especially when you are uncertain about the availability of the asset in future, especially more to do with seasonality related products. right? Especially when we are planning to look at the seasonality related products, what we will see is during the period in some periods the production happens, but the requirement or usage of that particular commodity will be throughout the year. So in some periods I expect that the prices will typically go up, whereas in some periods I expect that the prices will typically come down. That is the scenario where I am expecting that the product will again result in a production and the prices will come down. There is a possibility of a backwardation. So in commodity market you observe the scenario of backwardation quite heavily, whereas in regular in the financial futures kind of markets, the contango is the most common kind of a situation. Then the other comparison we try to do is comparing the futures price with the expected spot price. Because generally we hear people making the statement, whenever we talk about the futures price, it is equal to the expected spot price. When what could be the spot price on that maturity date? That is how people perceive the futures price as. So are these two really same? In what cases the futures price will be more than the expected spot price, and in what cases the futures price will be less than the expected spot price, is what we are going to deal here. Whenever you see that from a hedger's standpoint, the long and the short, both of them are equal in numbers, more or less equal in numbers. In that case, I can very well say that the futures price is more or less equal to the expected short price. But if more number of long positions are there compared to the short, we call that we call that to be a normal contango scenario. We'll discuss this is a difference between contango and backwardation. We use words like normal contango and normal backwardation. We have to understand that a small difference exists between the two. This is looked at from the perspective of hedges. If at all I see that the long as well as the short positions of hedgers are more or less the same, then we say that the futures market is a perfect reflection of the spot market, of the expected spot prices. But if I see the hedgers wise, the net long means more number of long hedging versus a short hedging. So when do I look at that? In that case, more people are getting into the futures contract because they are looking at it as a protection from the future rising prices. So there is a more demand for the futures contract. So whatever is the expected spot price on that day, people are ready to pay slightly more than that for that, because they are looking at it as a protection scenario. So more number of long positions are coming into the market rather than the short hedging positions. Means people are planning to hedge it. The buyers are going to hedge more because they are expecting that the market prices will rise in future. So because of that, more, and sellers are not that bothered. The sellers of the assets are not that much bothered because anyhow the prices are going to rise. So only the buyers are bothered more because they want to lock in their price, as they don't want to incur very high. So the seller of the asset now has to be compensated more than the expected for him to take that additional risk. So because of that reason, we see that the futures price will be more than the expected spot price. And because today the futures price is more than the expected spot price, and we have said as the maturity is approaching, the futures price has to come closer to the spot price. Today the futures price is more than the expected spot price. So which means in future the futures prices have to start falling. That is what we say. This is signified by the falling futures prices. The same logic probably if I am assuming now, when we are talking about a normal backwardation, futures price is less than the expected spot price. Why? The reason is very simple. Here the seller is thinking, the seller of the asset thinks the prices may go down in future. So he wants to protect his position more. So the seller wants to lock the price, whereas the buyers are not that much bothered. Buyer of the asset is not that much bothered because there is an expectation that the prices will fall in future. So what could happen? The seller is willing to transfer the risk to the buyer. So if at all the buyer has to take a risk, the price has to be much lesser itself. So that's where we see that the futures price will be less than the expected spot price. And again the same logic, as the maturity approaches, the futures price should be equal to the spot price, means we see that the futures price will keep rising in future. So whenever you have more of short hedging positions compared to long hedging, we see that the market is in a normal backwardation, and whenever we are seeing more of a long hedge compared to a short hedge, we see that the market is in a normal contango. So these kind of base understanding we need to have looking at futures price vis-a-vis the expected spot. When you have more or less equal number of long and short hedges, we can make an assumption that the futures price is a good reflection of the expected spot price. Then coming to some types of futures contracts, generally when I am looking at the treasury bills, hedging my treasury bills, or probably hedging the LIBOR based deposits, we generally use the Eurodollars as the hedging instrument, because Eurodollar futures are very heavily traded short term futures contracts. So to hedge my LIBOR deposits or treasury bills, we generally use the Eurodollar future contract. But if we have to understand, there is a difficulty in the pricing. For the simple reason, most of the times you see that the Eurodollar future contracts, they are quoted as 100 minus the 90-day LIBOR rate, or probably their pricing is on a discount yield kind of a basis, whereas all the deposits are priced on an add-on yield, which is nothing but whatever is the return on the face value of the deposit. So there is a difference in the pricing of these two instruments, so I cannot create a perfect hedge. But though it is not a perfect hedge, still we find that the volume of the transactions, especially for your deposits, for short-term deposits, people are using Eurodollar futures only for hedging purpose because of the kind of the volumes of the business they are typically operating in. And generally most of the calculations that are associated with the futures contract will be more or less identical to those of the calculations on the forward contracts, except for a couple of small things. When we are talking about for the bonds, as far as the regular bonds are concerned, right, as far as the regular bonds are concerned, whenever I am talking about the value or a forward contract price, we say spot price minus present value of the future coupons into 1 plus r to the power t. This is the regular pricing formula we have discussed for the forward price, or spot price into 1 plus r to the power t minus the future value of the coupons. Both of them will return to the same formula. So don't worry, if you are comfortable with one kind of a formula, that should be sufficient enough to address your practical scenarios, because both of them mean one and the same. But as far as the treasury bonds are concerned, imagine like this. Okay, I have got into a buying of a treasury bond. I am got into a long position on a treasury bond, wherein as a bond, okay, whenever I am talking about I am getting into a long position on a treasury bond, it is one particular kind of a bond. The long wants to buy the bond in future. Probably let's say the bond, the futures contract is, let's say, for 1 year, whereas the bond is a 10-year bond, and the current price of the bond is something. Now what is happening is, whenever we use the word treasury bond, it gives the short a wide variety of options to deliver, because all are treasury bonds. The treasury bonds exist with different coupons and different maturities. So as far as this futures market is concerned, treasury bond futures market is concerned, for a short there is an option to deliver any long term bond with varying coupons as well as varying maturity periods. So from that standpoint, the choice will always be on that particular bond which is having the cheapest to deliver, because at the end, because he has the short has various options to deliver the bond, he will choose that particular bond which is cheapest to deliver. So from that standpoint, what we are saying is, whatever is the futures price that we are computing, there is something called a conversion factor that is published for every treasury bond contract, so that the actual delivery will be the actual delivery futures price will be adjusted with this conversion factor, dividing the actual futures price that we have obtained earlier by the conversion factor to arrive at the updated futures price on that particular treasury bond futures. So just to, and when we are talking about the other futures like stock index or something exactly similar to that of forward contracts, we have dealt all those calculations in depth, so I don't need to really look at those calculations specifically. But one thing I would like to look at is the scenario of a treasury bond futures contract. Look at this. First let's look at the second numerical. We are talking about a futures contract which is 0.8 years to maturity. Right, this is today. This is 0.8 years to maturity. The bond is a 6% semi-annual coupon. So probably if I am talking about a face value of 1000, the coupon is 60 per year, so 30 per semi-annual. Okay, 12 years to maturity and the current market price is 1014. Risk-free rate is 5%. Now as far as this is concerned, what is the futures price for this? If we look at it, the regular futures price is the present value. You could understand the difference now. I'll take the numerical. The regular pricing is 1014 minus the present value of the coupon. Now the coupon is just now paid. So probably 1014 minus what is the coupon? 30, which is going to come after 6 months. So probably I'll take it as 1.05 to the power half, right? 1.05 to the power half, because this is going to come 6 months from now. So there is only one coupon during this period. I am multiplying this by 1.05 to the power 0.8, because 0.8 years to maturity. So this should be the price of the bond. Now if we see here, whichever is the bond, Now from a seller standpoint, let's look at this. How am I computing the futures price here? What are the inputs? What is the cost, the current price of the bond? 1014. 30 is the coupon that it is paying every period. That's it. Only these are the information that are going into the pricing of the futures contract. So any bond that is available where the current price is 1014 and which is paying a coupon of 30 every 6 months, that kind of a bond can be delivered by the seller. So how can he differentiate which bond is worth to deliver from this perspective? Because the pricing is only based on what is the current price, spot price, and what are the expected dividends out of this or expected coupons out of this. That's it. So from the seller standpoint, a wide variety of options typically come up, and he has the capacity to choose which one to deliver, and obviously that goes as the cheapest to deliver kind of a bond. That is where whatever is the calculation that comes out, we divide it by the conversion factor to arrive at the actual futures price for this particular bond. So just to adjust this numerical, if I have not adjusted with a conversion factor, what would have been the calculation? 1014 minus 30 by 1.05 to the power 0.5. This is 1014 minus 30 by 1.05 to the power 0.5. That is what is the difference. Multiply this by 1.05 to the power 0.8. This is what is the no arbitrage futures price for this treasury bond future. But of course, the conversion factor is 1.07, so I will divide this by 1.07 because each bond is having a separate conversion factor. So which means the actual futures price for this particular bond is only 956.93. Just to adjust for the maturity and the coupons that are associated, what we are saying is the futures price for this bond is 956.93. So as far as the treasury bond futures is concerned, this number is a very important number to be considered into our calculation, right? Then, okay, the other important thing with respect to treasury bills. A 30-day treasury bill is 7% and 120-day treasury bill is at 7.5%. Find the price of the future contract, 30-day future on a 90-day treasury bill. Probably it looks more or less similar to our FRA, forward rate agreement kind of an example, except for we should appreciate the fact that the treasury bills are quoted on a discount yield basis. So because they are quoted on a discount yield basis, we have to comfortably adjust for that discount yield in our calculations, right? So how do I adjust for the discount yield in our calculation? So the 30-day treasury bill is at 7%. So the 30-day treasury bill is quoted at 7%, which means what is the actual discount rate here? So for 30 days it is 7%. 7% per year. So for 30 days it would be 7% into 30 by 360. So what is the discount for a 30 day? The discount is going to be 7% into 30 by 360. This is how the discounted basis. So what is the price of this? The price of this is 1 minus the total discount. So this is around 0.994. Similarly, 120-day treasury bill, the interest rate is 7.5%. So what would be the typical interest or discount for this? 7.5% into 120 by 360. So this much, which means the price of this is going to be 90.975. So if at all I want to find out between 30 and 320 or 120, the futures price is nothing but the ratio of these two. So 120 day price divided by a 30 day price, which is working out to 0.9807. So the futures price for this is working out at 9807. In another way, if at all I want for this period, it's as good as the treasury bill price for 120 days. From the quote we are converting into price divided by the treasury bill price for 90 days. Whatever is the price that is coming out, this should be the quote that should be available as a no arbitrage price for the 30-day future on a 90-day treasury bill. So these are some of the most common kind of examples that are, and if it is with respect to equity futures or stock index futures or currency futures, all these things, the numericals and the calculations are going to remain more or less the same as that of the forward. So just on a differentiating note, these are some of the most common elements with respect to future contracts. I hope this has given you some level of clarity in terms of understanding the future markets and contracts in slightly more depth. Any further queries you have regarding the same, you can very well get in touch with me by giving me a call on this number or sending an email at this particular address. Thanks a lot for listening to this session. Thank you very much.